Okay, then I suggest that we start with the lecture. I propose to go through the things I prepared to discuss, to say during this lecture, and perhaps afterwards we can again open the space for the debate. Okay? Now the subject of today's discussion is the Eastern perspective, the perspective of Eastern and Southeastern member states of the European Union on the current economic and financial crisis in the EU. And to begin with, I would first like to present the structure of today's discussion, today's lecture. First, I would like to discuss what is the Eastern perspective in the EU. To be more exact, I would like to discuss how these new countries appeared on the eastern and southeastern borders of the EU. Then I would like to discuss in more detail the economic, institutional, international, political dimension of the Big Bang enlargement, the so-called Big Bang enlargement. And then I would like to look at the outcomes of the enlargement as far as the Central and Eastern European countries are concerned. And then the second big issue of this lecture is the European crisis as such, the current crisis, the causes of the crisis, and its consequences for various groups of countries in the EU. Again, to be more specific, I would like to look at how the eastern, southeastern countries fit into the usual north versus south debate on the eurozone crisis, and we will conclude this lecture by discussing what would be the position of the eastern and southeastern members in the most likely post-crisis architecture of the EU. Okay, so go to the first topic of today's discussion. As you all know, in the end of the 80s, the communist regimes collapsed, and so various new countries emerged on the eastern and southeastern borders of the EU. All these countries faced various economic troubles, the pressures of the global markets. They faced various institutional quality issues, and they faced lack of national resources. These countries, or at least most of them, saw the integration into the European Union as an opportunity to be able to develop themselves economically, to develop their institutions, and to be able to place themselves in the international community. On the other hand, the European Union saw the emergence of these new countries as an opportunity, economic opportunity for itself. It saw the emergence of these countries as it understood that in a way a kind of political mechanism will be necessary in order to secure this economic interest, so it knew that a Europeization process as a political mechanism will have to be put in place. As you all know, the Europeization process is the strongest foreign policy mechanism of the European Union. So they knew that a kind of political mechanism will be necessary in order to secure the economic interests. And of course, from the international political perspective, the European Union was kind of drawn into this new vacuum, geostrategic political vacuum that appeared in the East after the collapse of the communist regimes. Now, just to go through these countries very quickly, the countries that decided to integrate in the European Union, the countries that have put the integration into their national strategies were 3 Baltic states, then Poland, Visegrad countries, Slovenia and Croatia as Adriatic countries, and Romania and Bulgaria as two Black Sea countries. The CEEC. The CEEC, it stands for Central and Eastern European countries, but when you read it, it sounds like seek, because they seeked to get into the EU. They seeked membership. Okay. Now to continue, I would like you to look into the economic, institutional, and international political perspective of the enlargement in a bit in more detail. So, to start with the economic dimension, the future member states thought that by entering the EU, they will be able to use their economic resources more efficiently. They thought that they will attract foreign direct investments, and they thought that by being a member state, the free flow of the production factors will eventually lead to the convergence of the economic efficiency and, of course, of the economic growth. From the institutional perspective, they thought that by downloading European norms, European institutions, various types of institutional frameworks, and of concrete European policies, they will be able to improve the efficiency of their domestic governance. And finally, by being part of European institutional framework, they thought that they will be able to draw on the European norms, on the various European common policies, such as distributional policies, in order to enhance their national powers. The perspective of the EU was a bit different, was a bit more realistic. The EU mainly considered the new potential member states as an opportunity for its economic interests. As you probably know, the Copenhagen criteria on the membership are mainly about the ability of the new countries to meet the market forces of the EU, including the potential constraints of the monetary union that was then, when the Copenhagen criteria were set, only on the dashboard. From institutional perspective, they thought that through the Europeization process, they will be able to raise the pro-European elites in the new countries, and they thought that they will be able to establish liberal democratic institutions which were appropriate framework for various economic interests they had in the region. And from the international political perspective, they thought that these countries, new member states, will become more dependent on the core members, so their relative strength, the strength of the old member states will increase, and that the institutional framework of the EU as such will constrain various foreign policy actions of the new member states, so they will be able to control the political process, some of the main international issues, economic issues, by making these states a part of the Union and of its institutional framework. Now, to continue with the economic effects of the membership on the Central and Eastern European countries, to begin with the first chart. As you can see, with the enlargement, the export to the old member states, the export of the new members increased. Actually, the increase in the exports began earlier, but as you are well aware, various trade agreements were put in place before the enlargement, and the enlargement agreement was signed in 2002. The second chart on the FDI flows, well, the FDI usually fluctuates, especially with the small countries, but again, we can see a positive trend following the 2004 accession. The third chart on the GDP, as you can see, after the enlargement, again, we have a very positive trend. The average growth rate, real growth rate in the new member state was between 5 and 10%, which is quite a lot. And now, on the bottom of the slide, you have a chart demonstrating the convergence between the old and the new member states. The 100 stands for average GDP in the European Union. Following the enlargement, Slovenia, which had basically the best starting position and the highest growth rates, reached 90% of average European GDP in 2008. It was followed by Czech Republic. And here you can see other countries that joined the EU in 2004, and here these two lines stand for Bulgaria and Romania, which joined the EU in 2007. So the chart clearly demonstrates that the convergence gap between the old and the new member states got smaller after the enlargement took place. Okay, now to the second main topic of today's lecture, which is the crisis in the European Union, in the European Monetary Union. First, let us discuss the causes of the economic and financial crisis, how the economic and financial crisis generally evolves. Global financial and economic crisis, which was mentioned before, played as a push factor for the European crisis. Global financial and economic crisis was, in short, about bad loans, bad investments, and when these investments turned out to be irrational, debt had to be repaid, capital flew from the investments, disinvested, so this affected economic growth. There was a decline in economic growth, and state had to intervene. Modern state always intervenes in cases of substantial declines of economic growth, and modern state usually intervenes by decreasing interest rates, so it has this monetary mechanism affecting the price of the money, and as you all know, the price of the money affects the investments. The state, on the other hand, also has various fiscal mechanisms. Fiscal mechanisms stand for state spending on various programs. We sometimes say that the state intervention, the post-crisis state intervention, is anti-cyclical, automatic anti-cyclical intervention, because various mechanisms such as social supports automatically trigger when the unemployment rates begin to increase. Okay, so how did the financial and economic crisis in the EU evolve? First, I said there was a substantial disinvestment of capital and negative economic growth. and then state automatically or intentionally intervened. It intervened in order to preserve domestic economic activity, in order to guarantee social and political stability, and to sustain the level of national capital. Now, the problem in the EU was that monetary policy was of individual member states of the monetary union, was constrained by the rules of the monetary union. In the monetary union, the central bank of all the member states sets the interest rates on the money. So, due to the constraints of the monetary union, individual states, apart from the mechanism employed by the European Central Bank, could only draw on their fiscal mechanisms. This was not a problem until the scope of the crisis was equal in all the member states. But the problem appeared when the crisis appeared to be much deeper, much more profound in some of the member states. So, with the deeper, stronger crisis in some of the member states, these member states that could only draw on fiscal mechanisms faced first current account deficit because of the state spending levels, and the increase of foreign debt because they had to borrow money on foreign markets. State could not print money by simply lowering the interest rates, which then consequently affect the exchange rates, which consequently improve the competitiveness of an economy on international markets. So states could the states facing deeper crisis could not draw on the monetary mechanisms. They faced increased debt. Because of the debt that quickly increased, the foreign moneylenders began to treat these states as risky, so they increased the interest rates that were required in order for these countries to borrow money, and the increase in interest rates again affected the scope of the deficit, the scope of the debt. These countries were forced into structural reforms, and structural reforms always mean cuts, fiscal cuts, because there is never enough time for real structural reforms. And with fiscal cuts, there was again negative growth, again a pressure on economic activity, and the pressure on economic activity again increased the scope of the public debt. So these countries somehow found themselves in a negative spiral of growing interest rates, of negative growth, growing deficits and debt. The Troika, famous or infamous Troika, was put in place in order to intervene between the level or the scope of the interest rates and the structural reforms. Because the states themselves could not solve this situation, the structural reforms that were necessary were politically unsustainable, so to prevent the disintegration of the monetary union, the Troika mechanism stepped in. Okay, now just to go through the charts quickly. On the left, you can see the change in growth in euro area member states. The red line stands for southern members. So at first you see that all the countries faced negative growth at similarly, approximately same rates. But then the growth again returned with these anti-cyclical mechanisms. But with the return of the growth, the scope, the growth levels were not equal in all the countries. The southern countries faced lower growth or continuous negative growth levels. We have Greece I think this is Cyprus. On the right chart, you can see how the various growth levels affected the scope of the gross public debt. Red line again stands for the southern member states, the peripheral countries. You can see that in all the countries virtually at first the scope of the public debt in the GDP increased, but in northern members the scope of the debt relative to the GDP levels stabilized. In contrary, in southern countries, southern member states, the debt increased. Okay? Now to go on. To go on to the explanations of the crisis in the euro area. We have a narrow, common explanation of the crisis, and we have a broader, more structured explanation of why we are facing the crisis in the euro area. To begin with the more narrow, more standard explanation, as your colleague already explained, the interest rates on a hard currency, the euro is a hard currency compared to the currencies that were in place in the southern members before they entered the European Monetary Union. The interest rates on euro were too low in the years before the crisis evolved. So these countries took a lot of credits, they invested excessively, and these investments in the European Union, in the periphery of the European Union, attracted further investments from abroad. So various types of balloons, financial or real sector balloons, were created. In addition, there were also various institutional issues which supported the creation of these balloons, various institutional quality issues. The solution which is proposed, the common sense, the general, the usual, the typical, the European Commission solution, is that in order to avoid the departure from the European Monetary Union, which would mean that these countries, the southern members, could draw on the monetary mechanisms, substantial fiscal cuts must be introduced, and various institutional changes going in the direction of liberalization, privatization, and deregulation must be put in place in order for the market in these southern members to become operational again, to establish the right prices for various production factors. Apart from this narrow, typical, usual, common sense explanation, there is a broader structural explanation of the crisis in the euro area. This explanation is based on a position of the European Union in the globalization process. The European Union, as did many other countries in the Western world, faced increasing pressures, increasing competitiveness pressures and issues. It's been facing these pressures since the 80s, and it reacted on these pressures by slowly deregulating the rules in the financial sector. So did the US and many other states. Now, the deregulation of the rules acted in a similar manner as the money printing. It improved the access to the capital, to the financial capital. It lowered the price of the financial capital. But not for everyone, only for the investors, for those who had access to the banks, to the financial institutions. So this deregulation led to excessive borrowing, excessive investment, and played as a compensating mechanism because of the lower competitiveness, lower structural competitiveness of the Western countries, of the Western world. Now, where is the European Monetary Union in this picture? Many countries from the South, from the European South, also faced pressures due to the globalization process. And they decided to respond on those pressures by entering the European Monetary Union. Why they did that? They did that in order to be able to access to the credit, to the hard currency, to borrow money, and to place themselves into the capital-intensive parts of these emerging global supply and demand chains. So with access to the hard currency, they would attract investments, they would attract foreign investments, and their economies would be placed in the capital more intensive parts of global supply and demand chains. The countries from the northern part of the monetary union supported this strategy. Why they supported this strategy? Because by widening the euro area, by taking these countries in, they assure themselves better competitiveness on the internal market because of the common currency. So in a way, they could sell products to the European South because economic pressures on the European South could not trigger the lowering of their exchange rates. In this process, the financial deregulation played as a compensating mechanism for the European South. The European South was less developed in the 80s, so the money suddenly began to pour into these countries. The North also invested in the South of the Europe, so the North of the Europe helped to create these bubbles in the South in order to preserve the spending levels, the spending on their products. The Greeks, the Spaniards, they bought German products because they had the same strong currency. Now, with the beginning of the financial and economic crisis, this house of cards, this balloon, disappeared, and the real structure relations between different parts of Europe, between different economic positions, became more apparent. Okay, now where is the East, the European East, the new member states? Where are the new member states in this story? Here we have again the chart demonstrating the relation, the convergence relation between the old and the new member states. The red now stands for Germany. As you can see, with the recent financial and economic crisis, the gap between the most developed among the new member states, here we have Slovenia and I think Czech Republic, the gap increased. So with the crisis, the Germany is much more developed. Its growth rate is much higher than the growth rate of the most developed among the new member states. Actually, if you look at the data in the detail, the gap, the convergence gap between Slovenia and Germany is now larger than it was a couple of years before the enlargement. On the other hand, some other new member states continue to grow. However, their current growth is based on much lower levels, much lower initial levels. As you can see, these countries are now on 60% of average European economic growth. So we could say that in a way the position of eastern countries is similar to the position of southern states, the southern countries in Europe, but on the other hand, their position is also specific due to different development stages, due to the fact that only few new member states are part of monetary union and so on. As you know, Slovenia was the first to adopt euro, then a couple years ago Slovakia adopted euro, but that was already after the crisis, and recently some Baltic states also adopted euro. On the right, you have two additional charts. First chart demonstrates the gross public debt. Similar as with the southern countries, the public debt is increasing very at high speed in the eastern countries. And FDI again fluctuates, but in general there is a decline in FDI levels. Okay, now to conclude, I was thinking about how the current economic and financial crisis will further evolve and how will it affect various countries in the EU. We could divide this future speculation into three phases based on the time distance. On a short term, I think there will be no bigger substantial changes. The northern countries will continue to grow at lower levels. At south, we will still see increased economic pressures, and in east we will have a mixed situation. In the middle term, I think that the competitiveness issues will re-emerge in the European North. We will have zero growth in the northern countries, the northern EU member states. The northern countries will probably propose deeper integration in a sense of increased mobility of production factors. There will perhaps again be a debate on a multi-speed structure of the European Union, meaning that some countries will follow some of the more strict economic rules, other countries will go their way, but again with less benefits, with less resources distributed from the center. And I think that here much depends on what will be the position of France, because France is today somewhere on the edge of the north and the south, but France is a big and important country. The direction of the development of the European Union has typically depended on the coalition of France and Germany. So how the crisis and the current situation will affect France will probably determine the direction of the EU on the middle term. In the new member states, in the middle term, I think we will see moderate growth in some countries, increased economic pressures, and for sure we will see increased economic segmentation. We will see the increase in Gini index, for sure. In the middle term, there may appear a strategic alliance between the southern countries, perhaps even between the southern and the eastern countries in the EU. Until now, we have not seen such a thing, though it could be expected. And on the longer term, I think European Union will adapt a kind of protectionist measures because of the competitiveness issues. We can already see this kind of measures in many policies. For example, with the common agricultural policy, we can already see a turn towards the protectionist measures, the strengthening of the protectionist discourse of the European Commission. And regarding the internal issues, I think that there will be a debate between deeper integration and redistribution, but I'm pretty confident that without strong distribution, there will be no European Union, no integration on the longer term.